Good afternoon. My talk today is about the ship recycling bear market. And I know that this is not a market that many people actively pay attention to, but as you will see, I think it offers unique insights to help us understand what's happening in other markets which all of you care about. You are now looking at a portrait of Betty Mills, 90 years old, and Don Journey, 91, who met 2 years ago. They just got married. Isn't that sweet? They're obviously in love, and what a bright future they have ahead of them. Not necessarily a long future, I think you would agree. But wait a minute, what if everyone's to surprise they lived another 30 years to the age of 120? That statistically unlikely phenomenon is what we are now witnessing in most global shipping markets. We are at all-time lows of ship scrapping, matching the trough we saw in October 2005. That's right, exactly 20 years ago. Shipping is notorious for its cyclicality, but it's still amazing to witness just how regular the cycles are. When we zoom out, an obvious explanation comes to mind. Earnings since COVID for every single shipping segment have been the highest in 20 years. In fact, earnings are so high that no one wants to scrap their ships, and that's simple enough. So, what more do you need to know, right? Well, I hope you'll forgive me, but I couldn't resist the opportunity to pay homage to Socrates, a resident of Athens, because if we want to know why things are the way they are, it's not enough to accept the obvious explanation. We have to dig a little bit deeper. So, to start, let's examine the financial incentives for keeping vessels trading instead of selling them to be recycled. And believe me, those incentives are very compelling. In June of this year, this very large crude carrier built in 2003, 22 years old, was sold for a continuous trading for an eye-popping $37 million. The vessel, which is now named Asteria, has been pretty busy for a 22-year-old tanker since that transaction. Not surprisingly, she has visited offshore Iran, Malaysia, and Chinese ports. In other words, she's part of the dark fleet or shadow fleet. It's not easy to find out what these vessels are being paid on these voyages, but traders I communicate with assure me that their earnings are usually something like 50% to 100% higher than what the compliant vessels are earning at any given time. Now, what if she had been sold for scrap instead? These days, an oil tanker could expect to fetch about $410 per LDT at an Indian scrapyard, which is the most likely scrapping destination for a large tanker today. LDT, as many of you know, is light displacement tonnage. It just means the weight of the empty vessel, no cargo, no fuel, no crew, no ballast water, nothing. This vessel has cargo capacity of 300,000 deadweight tons, which converts to about 42,600 LDT. If you multiply that by the figure I gave a few minutes ago, $410 per LDT, you get an estimated $17.5 million, which is what you see on the right. Who in their right mind would sell something for $17 million if they could make twice as much? The only owners who care about who they sell to would never own a 22-year-old vessel in the first place. They probably would have sold it 5 or 6 years ago to someone either here in Greece or maybe in the Middle East, someone discreet in China, someone just clean enough to meet their KYC compliance requirements. After a couple of years of trading, those owners discreetly unload them further, and the only traces we see are on those weekly broker reports with undisclosed interests in the buyer column. In order to ship scrapping to finally bottom and head higher, we need one of two things to happen. Either on the left, on the right, scrap prices go down, or scrap prices go up, or the vessel value comes down. Now I want you to look at what's actually happening. Let's start at the top. Since 2023, scrap steel prices have gradually declined. If you're an owner, why would you go through the trouble of scrapping a vessel at all if the profit you can make keeps dropping? Now we turn to the bottom chart. Since 2022, for many different reasons that all of you are familiar with, old vessel values keep heading higher. In other words, the spread is actually getting wider over time, not narrower. Now, the part of this story that many of you are familiar with as shipping professionals is persistently high vessel values, which correlate to above average earnings. As long as earnings are good, the outlook is good, owners will continue to pay prices well above historical averages, even for the older vessels. Every single shipping sector has enjoyed a generational bull market at some point since COVID, and many of them are still enjoying high earnings. I want you to take a moment to look at this chart from Clarkson's, and I find it astonishing that out of the 19 individual different shipping and offshore segments, each with their own distinct cargoes, each with their different geographies, 90% are enjoying above average earnings. In fact, some of them are enjoying several standard deviations above those averages. But I want to leave aside the vessel values side of the equation and dig a little deeper into ship recycling because, after all, that's what this talk is supposed to be about. This is the important and incredibly dangerous process of completely stripping and separating vessels into their components and their scrap materials. It is, to be frank, one of the most dangerous jobs in the world. What follows is a little bit of a crash course for those of you who have never taken an interest in the intricacies of the scrapping market. The major ship recycling yards are in 3 countries, from left to right: Pakistan, India, Bangladesh. You can see the main beaches where scrapping takes place on this map. I know that there are probably some owners in the audience. Your vessels may have been built in Korea or Japan or China, or maybe even Turkey or Croatia, but they will all end up there. These beaches are effectively ship graveyards, sometimes 10 kilometers long or longer. And about 80% of shipbreaking happens here due to a combination of several structural advantages which the Indian subcontinent offers: favorable tides, very low labor costs, and proximity to steel mills. These local steel mills know that the steel used to make these ships may be old, but it's excellent quality. So they either reshape it or they melt it down and they reuse it. And in Bangladesh, as an example, 60% of the steel is made from feedstock such as this. First, the ships are auctioned by the owners or brokers, and then they're emptied and prepared, and then they anchor near the beaches. You might be wondering, how do they beach the ships when there is no infrastructure, no docks, no ports? Well, typically the vessel sails under its own power at high tide, navigated by a specialist captain, at close to full speed, so 10 to 15 knots, and they just run it aground. Needless to say, this is my 7-year-old son's dream job. There is a reason why the region's beaches are perfect. Thanks to their tidal range, which varies more than 3 meters, they can easily get the ship onto the beach, and when the tide goes out, the hull becomes exposed, which facilitates the work. India has the best natural conditions of them all because the tidal range is 11 meters, that is to say higher than the ceiling in this room. Anything that can be reused is removed and sold, so the engine, electronics, fixtures, even furniture. They start from the upper decks, and working down, workers use cutters and shears or even wrecking balls, as you can see here, to remove the superstructures, the pipes, the bulkheads, entire sections of the hull at a time. Steel plates comprise 90% of the ships, and they're cut into more manageable pieces, which are lifted by cranes to dry land. This takes many months and dozens of very poorly paid workers. Now, I want to come back to this slide. Focus on the top. This is the crux of the issue. Lower earnings for ship owners help bridge the gap between sellers and ship recyclers, but if we really want to see the ship demolition market bottom, the steel market needs to rebalance, and this is where this talk is going to take an interesting turn. You may be wondering what is causing this secular decline in the price of steel. This chart is the key. Look at that acceleration of steel product exports, especially in the second part of the circle, since the end of 2023. This is how I would summarize the situation. The relationship between Chinese exports of steel products, which is going up, and scrap steel prices, which is going down, is inverse. Surges in low-priced Chinese steel exports, which are made by mills which often produce steel at a loss, depress scrap prices everywhere and erode local demands. So those steel mills in India, Bangladesh, and Pakistan, which would normally use scrap steel, instead just buy semi-finished and even finished products which are even cheaper. These are Chinese-produced steel billets. It's a semi-finished product which is used to produce bars and rods and tubes and pipes and all that stuff you think of when you think of infrastructure projects. In the first half of this year, Chinese exports of these surged 300%. China sells these at a $50 to $150 discount per ton versus what people can buy locally in India, Bangladesh, and Pakistan. So you would be crazy not to buy this instead. The oversupply of Chinese steel grew 9% this year. That's right, it's getting worse every year. And yet, Chinese steel mills are becoming less profitable over time, as you can see. China makes more than half of the world's steel now. As its capacity grows, its actual steel consumption at home continues to fall. It fell 7% this year due to China's weak construction sector, slowing domestic infrastructure projects, and increasingly poor demographics. So, China subsidizes its steel production 10 times more than OECD countries and 5 times more than its Asian neighbors. Steel producers get low-interest loans, they get tax breaks, they get discounted land, sometimes they get free land, they get energy rebates for the electricity to make it, and export incentives. The sector is dominated by state-owned enterprises which are encouraged to run at full capacity. The question is why? The answer is China wants to protect these workers' jobs. The Chinese government view can essentially be summarized as follows. Why should Indian recyclers have jobs when our steel workers can have jobs instead? And when the Chinese decide that they're going to dominate an industry, the best thing for you to do is to change industries, because you can't compete with companies who are not afraid of losing money. Now, there is another industry which China dominates at the other side of the shipping's life cycle than scrapping, and that is shipbuilding. And right now, we are witnessing a trade war unfold in which America is trying to incentivize everyone to stop being such good customers to China's shipyards. The current US administration sees this as a strategic priority. And while I find many of the president's pronouncements distasteful or even morally repugnant on occasion, I must admit, on this topic, he kind of has a point. As an investor, I am highly incentivized to see things as they are, not as I would prefer them to be. If I become blinded by my opinions or my biases, I lose money. So speaking as a realist, I have bad news and I have good news for all of you. The bad news is that this trend is not going to change. Steel prices are not going to recover because this overproduction is intimately linked to this man's signature project, the Belt and Road Initiative. Let me explain. Some of you may be familiar with the brilliant innovation of Gillette razor blades. They created disposable blades, and they gave the razors away for free. So during the First World War, every soldier was given a razor, and he bought the blades. It was an incredibly successful business idea. China is doing something similar. Through the Belt and Road Initiative, China is selling their steel at a loss. They're giving cheap credit, but in exchange, they want every country on the planet to hire their state-owned engineering firms to design and produce every one of those projects. Here is a concrete example many of you are familiar with, Simandou, the massive iron ore mine about to ship its first exports from Guinea in West Africa. Although the project is not officially a Belt and Road project, the mechanisms are exactly the same. The mines are more than half owned by Chinese interests. The workers are Chinese. The rail infrastructure is being built by Chinese. And the ships which will load the ore and haul it are mostly Chinese. And guess where they're going? They're going to China. And it will all be used to do what? To make more Chinese steel. And what will they do with that Chinese steel? That's right, they're going to export it for more of those Belt and Road Initiative projects all over the world. And that answers the question which many analysts have been flummoxed by. If the real estate sector in China is so bad, why are iron ore imports at all-time highs? Why are metallurgical coal imports so strong? Why are steel exports at all-time highs? And that is the good news for all of you. Because if you came to my talk, some of you may have been hoping to hear an investment idea. And that idea is buy dry bulk stocks. Thank you.